Good morning. This video is designed to review a number of issues related to what Warren Buffett is doing with the trading relative to oil prices that are going on right now in North Dakota. My goal is to first review what's happened recently and how Warren Buffett has responded to it, and then follow that on with the prediction of the possibility of what I call $25 oil. So as I covered in my first video, a situation occurred, which is oil prices went from, let's call it 120 to $26 a barrel over a 1-year period. This was a classic case of what's called, in economics, the prisoner's dilemma. So basically, the driver for this, or the tipping point for this, was what's going on with oil in North Dakota. Now, North Dakota is not that far from Canada. When I heard about the oil that was being discovered in North Dakota, I actually didn't take it seriously because I thought that, there would be a little bit of oil, they'd dig it up, ship it out, and then, just like what we've seen with the oil pipelines in Texas, they'd be drilling, let's say, close to shore where it was easy to find. All of that oil is now tapped out, so they keep having to move further and further out into deeper waters and dig out more expensive oil. So it's my perception that Dakota would be no big deal, or North Dakota and the baken fields would be no big deal. It turns out that it's completely the opposite. What actually occurred is that the introduction of the oil coming from North Dakota to the global oil system was a tipping point where the United States went from the 4th or 5th largest producer of oil in the world into the number 2 position. And when this happened, combined with things like China reducing consumption, maybe a little slowdown of the economy, that combination resulted in a huge drop in oil prices that a lot of people were taken surprised by, even people who were part of creating this problem or opportunity when it comes to fracking. So I wanted to review this with you because my first impression was, forget about it, this is no big deal. Oil prices will weather this. As soon as all that oil is gone, we're done with the issue. Clearly, that's not the case. There are long-term, perhaps billions of dollars or billions of barrels worth of oil sitting in North Dakota, ready to be mined. The next stage of this dialogue focuses on Warren Buffett and his reaction to it. His reaction was he purchased a railroad. Moving oil by railroad is much cheaper than doing so by truck. So in essence, and the rail lines were already going right by where this oil was being pumped. So Warren made the quick move to go ahead and purchase 2,000 double-hulled tankers to carry this oil. And they're on back order because it takes a while to make these tankers. What then happened was, as we know, after he purchased those tankers ready to move the baken oil, suddenly there were pipelines within only a few hundred miles of there that within a year were able to consume at least half of the production coming from that area. So what this resulted in was Warren's train moves a gallon of oil for 15 or a barrel of oil for $15 a barrel to the refinement centers in Baltimore, or let's say Texas. The pipelines can get it there for $3 a barrel. So his facilities are no longer competitive. So this brings on a further look at how and why Warren reacted to this issue. Obviously, the first move is to slow or maybe cancel some of the ordering he's done, which results in some losses. But the other sort of issue that he noticed or concluded was that there are certain entities, particularly transportation companies, that are heavily levered to the price of oil. And the question was, for his time horizon of investing, which typically is 3 to 5 years, what was he facing? The answer that I see him coming up with is that we're in a low oil price and going lower environment. So that's the third part of what I want to cover right now, is where I see oil prices going. So what happened when I heard about this possibly lower oil prices, I was like, well, that's ridiculous, because the cost of fracking is at a certain number, and therefore you can't lower that price. I talked with some of my friends who are expert in the industry, and they said all they have to do is lower costs and everything will work out. So what's interesting is that the break-even point as of a year and a half ago for that North Dakota oil was somewhere around $60 a barrel, maybe it was 55. I thought they couldn't lower their costs because they couldn't change technology fast enough to drop those costs. What happened was that all of a sudden these pipelines started extending into the area, including the Bakken pipeline that's being protested right now. And they're causing the break-even price, let's say from before, to go from in the range of $60 to now in the range of the high 40s. So that means that people could ship oil profitably by pipeline out at lower prices. So what I see happening in the near future is that as these entities start pumping more oil because they can actually make money, let's keep in mind there are 5,000 wells that were tapped because they couldn't make money. So they didn't have to drill new wells. They can just open up the ones they already have drilled and start profiting from the higher price of oil that OPEC has now brought in. So what I believe is going to occur is that oil prices definitely could stay where they're at. I actually think there's a mandate for possibly a $25 to $30 a barrel oil. And this is a legitimate threat to the economies of Canada and other places that rely on this. And I think that the confluence of lower costs of fracking combined with lower cost of shipping, there's a discussion of Mr. Trump of oil prices rising because the global economy gets stronger. I actually see his friends that now bring more pipelines into the mix, lowering the cost of goods sold for the oil people to the point where this could cause a flood of oil to hit, and airlines being one of the biggest beneficiaries, especially because the airlines have now gotten down into not quite a monopoly, but a small number of players who can instantly bring lower costs of fuel to their bottom lines. So, this is my second drill at looking at Warren Buffett and the impact of oil prices on what he is doing with his investing. I also think he chose the airlines because, unlike other transportation companies like FedEx and UPS, their competitive landscapes are different in terms of the number of entities that are available, including Amazon, that are building out facilities to compete with them on the delivery side. So thank you for watching. Please like and subscribe, and look forward to producing more in this area as we see where oil prices go and how it impacts things.